Shilpa, I'll start with the introduction so we can say one time.
Yes. Mr. Ravichandran is available. No. Okay.
You can call him.
Yeah.
Okay. Meantime, let me just start with the introduction. Good morning to everybody and welcome to this CEP session, which has been organized by Bangalore Valuers Association together with ACBA. We have a number of members who are valuers who have been looking for topics which help them in their professional practice. And as a part of this endeavor, courtesy Mr. Ravichandran and Shilpa, we've got a very good topic and a great speaker, of course. Now, this topic for us is an evergreen one because it's something which happens at the end of every year. So it's appropriately placed also, I would think. It helps us because the auditors tend to finalize their financials after seeing the ESOP reports. So potentially this is something which is of great use to us at this point of time. We have in the past held a couple of programs on ESOPs. We've provided our members with Excel sheets, with report formats. So I hope that this program, which seems to be at a more advanced level as compared to our basic level, which we provided to our members, will be of use to us in our practice. Let me also mention that as far as BVA is concerned, since we hold our professional, our CEP sessions every fortnight, we have tried to give all our members the requisite CEPRs over the course of the year without too much of a hassle. So you don't have to rush for the CEP at the end of the year. Today being a certain day in which probably one of the last sessions for the year, I think that the number of registrations have been beyond what is permitted by IBBI. So we hope that going forward, some of the people who are here one time will become members of the BVA so that we can enable you to get your CEPRs regularly. With this short introduction, let me hand over to Shilpa. Over to you, Shilpa.
Good morning, everyone. One of our BVA member, Mr. Ravichandran, has introduced today's speaker. I think he is not able to connect, or he was on vacation. So we are all very lucky. But let's see whether he'll be able to join.
Shilpa, sorry, I have joined actually. Okay. I just joined, but I request you to introduce the speaker and carry on. Definitely, I will not miss anywhere in the world actually. I'll be there. Yeah.
Okay. All of you can see the speaker's profile. I have shared my screen.
Yes.
Mr. Balasubramanian TV is a very veteran and a well-known registered valuer in Chennai. He's a specialist in business valuation, business processes, and strategy consulting. Of course, his profile is too big. I'm just taking snippets from his profile. He has been involved in valuation engagements spanning multiple countries, varied industries, for varied purposes for over 20 years. Sir, we are really lucky to have you among us, and we are lucky to hear us today. As we can see, valuation engagements he has done of different categories, and he has handled due diligence engagements and acquisition transactions across multiple geographies and industries. Over to you, sir. Thank you.
Thank you all. Let me share the presentation and then we can straight away go ahead with the session. Just give me 1 minute for that. The meantime, just wanted to check that the Excel sheet has also been shared to everybody already, right? The participants?
Yes, okay, yes, it has been shared.
So then we can. I hope you are able to see the screen. We can go ahead.
Yeah, Shilpa, Excel was shared by what? Email or WhatsApp?
Shall I put it in the chat? In
Yeah,
BBA members also it was shared.
Okay. Yeah, would be good if you could share in the chat because I didn't check my email, didn't get it. I think other people are also saying haven't received, so you can kind of put it in the chat. Yeah. Thanks.
Basically, in the Excel, I have the base workings of whatever I am going to cover in the presentation. So it will be useful as a tool when you're actually working on the valuations. Straight away, there is a ready templates there. So it can be shared, but in the meantime, we can go ahead with the presentation, I suppose. Straight away, let me get on to it. We will work to the time. Overall, I'm going to be covering about ESOP valuation when it is to be done. So this is one area of concern always. So that is first I'm going to talk about that, and then ESOP grant, what is required at that time. Then in terms of accounting, what are the requirements under the Indian conditions. Then I'm also going to touch upon valuation of SARs and phantom shares, treatment of existing ESOP when you are doing valuation for other purposes, say for example, the fundraise. So this is broadly what I'm going to be covering today. And then we will have some questions coming up. So first, with regard to valuation of ESOP, when it is triggered and what is expected at that point of time. So first is at the time of granting the ESOP options. So here the purpose of valuation is only for accounting of ESOP cost. So that is the purpose for which it is done. Of course, very theoretically, there could be a valuation or there could be a estimation which is involved in even designing the ESOP scheme. So there could be multiple scenarios which can be worked out, and then based on that, the management could even decide how to price and what to give in terms of ESOP. So that is a more an advisory service which can come along with this. Then at the time of grant, the valuation is done under the requirements of Companies Act, and more specifically under the accounting standards or guidance note, which is also broadly part of the standard framework which we need to adhere to for accounting. So it's purely for the purpose of accounting. And because it is for accounting, my own interpretation is because accounting standards come under the Companies Act, it needs to be done by a registered valuer. It's a gray area. Some people take it that it need not be done by a registered valuer. Actually, there is no mandatory requirement for a registered valuer's report or a valuation report necessarily at this point of time. If the company has the skill sets, they can themselves estimate it, and if the auditors are fine with that estimation, then they can go ahead with that, because these are standard templates. There are only 4 or 5 variables which somebody needs to apply judgment on, and that is something which some companies do. They themselves estimate this internally. And then the item to be valued here are 2 things. At the time of grant, there are 2 things which needs to be valued. The first one is the equity share if it is an unlisted entity, because you need to know the value of the underlying asset before you can value the option. The second is to value the option itself. To just give you an example, take, let's say, Hindustan Lever. Today, let's say the market price is 1,000. We know the share price is 1,000. Fine. So that is the first thing we need to understand for us to determine the value of the option, which I will explain. Now, if somebody offers you that share and says, okay, you can buy the share of me at 1,000 rupees, same 1,000 rupees, anytime in the next 3 months. Now, this option has a value, which is different from the 1,000 rupees share price, because that is the price of the share. But what is the value of this option? This option is that in the next 3 months, if the share goes up, you can buy it at 1,000, you can make the differential money. Whereas if it goes down, you don't have to do anything. So that option has a value. So that is the second part of what we are doing in this purpose. Now, this is the first time when valuation is required. The second time when valuation is required is at the time of exercise. Whenever the options are vested, and then after vesting it is exercised, it needs to be valued. Here, the purpose of valuation is for taxation in the hands of the employee. As you all know, the ESOP is considered as a perquisite in the hands of the employee at the time of exercise. So at the time of option, there is no taxation on it, absolutely straight. But at the time of exercise, there is a taxation which arises. For that purpose, there is a need to value it. And that is done under the Income Tax Act. And this needs to be done only by a merchant banker. So we have to be very clear that this point of time, as of today, the law requires that the valuation has to be done only by a merchant banker. It cannot be done by a registered valuer. It cannot be done by a chartered accountant, whatever you call it. It's only merchant banker right now. And then at this point, actually, what is being valued is only the equity share if it is unlisted, because here the calculation is based on the value of the share and the strike price they are paying. So it's a simple calculation of taxation. So for that, there is need only for equity share. And because it is being exercised, there is no more value for the option. So that is the purpose why we are only valuing the share there. So you need to, one of the things which I want to emphasize is that generally ESOP valuations can be different from other valuations in terms of the value you arrive at, because the purpose is different. But at the same time, you need to take due care of any other valuations happening around the same time to see that it does not raise a dispute. For instance, let me give an example. Let's say, I'm theoretically speaking, I'm not getting into any tax disputes or something. I'm only just theoretically postulating a possibility. If you take, let's say, ESOP is there in a very large company, the ESOPs make up for 0.1% in the hands of the employee, right, of the state. And at the same time, let's say there is a new investor who's taking over a substantial percentage, 51% of the company. Now, if the new investor is buying at 250 rupees per share, you need not necessarily say that the ESOP valuation for the share also at that time is 250, because both reports are around the same time. You can always justify maybe a percentage towards control premium, which is being paid by the new equity investor coming in versus a 0.1% stake, which is there. This is the theoretical postulation, but mostly for a taxation purpose, they actually take, if there is a transaction happening around that time, they take that price because that is the price which they ultimately realize. Most of the times, this is also sold immediately along with that, right? So that's actually realized. So, but theoretically, if he won the exercises and there is no sale happening, theoretically one could differentiate, which I will talk about a little more when we go in. SARs are to be valued at each period end. So because this is based on the price increases as it's happening, so this needs to be valued at each year end. Whereas options per se are not revalued in the normal course, and they are accounted based on the valuation which was done at the time of grant. So this is the background to it. So now let's look at valuation of shares at the time of grant. What are the key issues and what we need to consider? Now, this is the point I was trying to make. There is a difference in what is fair value depending on what is the purpose for which it is being done. There are key considerations which vary between an ESOP valuation and for, say, a strategic investor or IPO valuation. ESOP is based on more fundamentals. Discount for risks related to being an unlisted share is very fair to put that. When ESOPs are being issued, there is no immediate known roadmap for IPO. So you don't know how the liquidity is going to be for your shares. And it is the purpose is also to make it attractive for employees to either stick around for longer or contribute better for the company, etc. Whereas in the case of a strategic investor or an IPO, the whole thing is based on sentiments. If market is booming for that, then the valuation could be significantly higher. There is also strategic intent on global possibilities. There can be control premium. So it is for maximizing value to the company. So these are on different buckets. So the approach to valuation could be different in valuing the same share when you are valuing it for different purposes. Now, I will go to the next thing and also explain. Okay, I will explain the case with one example. MT Educare, of course, today MT Educare is known for many other things. I'm not getting into that. I'm only restricting myself to the ESOP reporting which was there and the valuations which are there. MT Educare, I did a computation based on the ESOP schemes as reported by them in the annual report, public domain information, which is there. Now, looking at the information they have provided for their ESOP 1 and ESOP 2 scheme, right, you can compute or reasonably estimate what is the kind of ESOP cost which they had arrived at. Now, this is in the backdrop of a public issue which came out in 2012 at 80 rupees by them. And these ESOPs were given prior to that in 2011. Now, if you look at that, the value which is ascribed as ESOP cost is around 37 lakhs and 78 lakhs, which if you translate into per share, what is the cost? It comes to around 36 to 38, which is nearly half of what is the IPO price just within a year's time from there. Now, this clearly also shows that what we are talking about as theory is not only theory, this is what is there in practice. In fact, this is just one example I have taken and provided here. I had done a comparison of multiple companies which did IPOs and ESOP, say 6 months to 1 year prior to that. And nearly everywhere I found that the difference was about 50% of the IPO price, by and large. Right, by and large. In fact, there was a case where TCS had issued at 1 rupee when the public issue came out at 950 rupees. I mean, that's an extreme case, but you can have different things which can come up. So now, how exactly is this being computed? There is a clear template. This template is also provided as part of my Excel sheet, which I have shared. So based on the data which is there in the annual reports, you can recompute and find out at what price is it coming to 36.56, because this first part of price per share is actually not reported in the annual report. It's not required to be reported. So what is reported is the exercise price is reported. The parameters which they have used, like the risk-free return, the volatility, the dividend yield which they have considered, and the number of shares and the total ESOP cost. These are things which are reported in the annual reports as required by the standards or the guidance note, as the case may be. So because this information is there, you can always back work to find out what is the indicative price. So here, this is what I was talking about, 36 to 38 rupees is what you are getting as the pricing at which they have considered the shares at the point of options being granted, which is nearly 50% of the IPO price within a year's time. This is from MT Educare itself for the base working. Now, again, in hindsight, we are looking at this. This I am presenting more to give you an idea of probably how approaches have been different, right? We are looking at it in hindsight, so I'm very, very clearly putting that across. So comparatively, how this could have come about, the conservative model versus the more aggressive model. Now, if you look at it, this is the March 2011 reported numbers. This is the September 2011 reported number. March 11 numbers are most likely to have been considered for ESOP, and September is the latest numbers which should have been more likely considered at the IPO time. So if you look at it from that perspective, the book values were 13.9 and 16.18 at that point of time. And if you take the price which is coming up at the ESOP time and the IPO time and the number of shares which were there, the market value, if you multiply these and arrive at the market value, it was estimated that the market value was 12,600 crores at the time of ESOP computation, market value of equity. And IPO time, the market value is considered around 28,000 lakhs. So there is a 126 crore to 281 crores jump in valuation, which is there. Now, these are the actual PAT over the years in the past. So if you take average PAT of 3 years trailing, you see there is a significant jump between the time when ESOP was considered and the average PAT. And PE ratio based on 3-year average, not taking the latest PE average, but 3-year average, and PE ratio based on just last year, both were significantly increasing. So this is something which very clearly shows that the valuation of 126 crores at the average PAT or the latest PAT was at a much lower PE versus a much higher PE being considered when it was being done for IPO valuation. So this clearly again postulates the same position that the valuation for IPO, the valuation for strategic investments, and the valuation for ESOP could be on a completely different approaches or varied approaches. So this is just a computation of what could have been the method from which it could have been derived. So for example, if you take here, the latest profit was 824.95, just an example at the ESOP time. So 824.95 number of shares. So the EPS was 2.4. And that time the average PE was around 20 for the market. I have just taken a simple example, and 25% illiquidity discount. If you take, it comes to 15. At 15, it comes to around 36, 37 rupees. So here, if you will find that they have used the market PE at that time and have also discounted for illiquidity. And I've just assumed the latest PAT would have been used for the purpose, or the PE, EPS would have been used for that purpose. Now you look at the next case scenario. The PAT for half year of 2012 was 975. Now they are not even taking trailing, they have taken half year and annualized it, possibly, and arrived at a much higher EPS to start with, 5.55 as against 2.4. This again is hindsight based on available information. I am back working to see what could be the logic, why aggressive stand and why conservative stand. And a much lower liquidity discount being adjusted at that point, primarily because of the company going in for IPO. Alternatively, they could have taken trailing and maybe no liquidity discount because they are going in for an IPO. That's what comes to close to 80 rupees. So this shows clearly how there could be a significant variation in the way you approach to the valuation depending on the purpose. So the crux of it is, when you are doing it purely for ESOP, you do it in an unlisted entity. In a listed entity, of course, the drivers are different because the price of the share is fixed. There is no valuation involved in that. So you go on a conservative basis. So that is something which I wanted to place here very clearly, because this is a fact which we need to consider appropriately. Many of the valuations we will be doing will be for unlisted entities, and their valuing the shares become very critical because it has significant accounting implications of what is the cost you're going to book. So this is one example of what I was saying, that it's not only in FT Educare case we have seen this happening. This has been happening across multiple bases. So if you look at the ESOPs at that time, it's all around 10 years back. So you will find Tata Consultancy, ILFS, IDFC, Ardecon. So all of them had done the valuation much below the much below the IPO price, and it's all within a year's time between the ESOP and the IPO. Now, the first thing which we looked at was to value the share, right? Value the share in the case of an unlisted entity when it is going in for ESOP grants. After having valued the share, there the key takeaway which I want you to all remember is valuing the shares, you have to be on a conservative basis rather than an aggressive basis, which would be used for an IPO or for a purpose of investment stake sale. So this is something that I wanted to give as a key takeaway there. And then next is to, once we have determined the share value, we need to determine the option value. This is a simple computation. There is a huge complex mathematics behind it. Fortunately, we don't have to remember all that. There are ready tools available. So we need to only understand the principles and the areas where we need to exercise judgment and how we can go about exercising that judgment. So this is the focus I am going to have on this. The mathematics is already proven, etc. We need not go into it. The Black-Scholes option pricing method is one of the most popular method in determining option valuation. It basically makes these assumptions. The underlying stock call options do not provide any dividends during the option period. That is, there is no dividend declaration expected in the option period. This is the first assumption under a PSOPM model. Then it also assumes there are no transaction costs involved, or it is so immaterial you have not considered that essentially. Then risk-free rate return is considered constant over the life of the option. This risk-free rate return is something even in DCF, many a times we take a single rate for the whole period. But those are certain assumptions and those are some simplifications we are making. In real life, it does not remain so. But this is basically one of the assumptions which goes into it. So if the option is for a very long period, you may have to look at other fine tunings to those. But in the normal course, this is good enough. Then the next assumption is that there is no lot. It essentially expects that any fraction can be done by anybody. So that is the next assumption. And there is no penalty for short selling, which is considered in this. Whereas all these could, in real life, make changes. In fact, that's why you will find that the option prices which are quoted and available in the market can vary significantly. And then call options can be exercised only at its expiration date. Security trading takes place in a continuous time. These are the basic assumptions underlying BSOPM model.
So one question can I ask here?
Yeah.
This second last assumption, right? Call option can be exercised only on its expiry date. Does this kind of limit the applicability of the Black-Scholes option pricing model when, let us say, an ESOP scheme says that the employees can exercise their option at any time after so-and-so period? At times, companies limit the option exercise time to maybe for practical purpose, expediency purpose, maybe for 1 month or so. But at times, you do come across certain ESOP scheme where they say, let us say, if the vesting period is over, they can say, once the vesting period is from that time till any time, maybe 1 year, 2 years, till the time they leave or whatever, these options can be exercised, right? So the impact of such a clause in the exercise saying does it limit the applicability of the block and tools option pricing model to calculate the value of the option, or we can still go ahead and use black and tool? In your Excel example also earlier, when I saw in the two cases, one the expiry period was some point somewhere, the other was 1.9 years or something in the table that you showed. So what is the I mean, net the question is, what is the impact of the company giving long periods of exercise to employees? Does it render Black and Scholes model unusable? Should we go for binomial tree or Monte Carlo or whatever? Or we can still go ahead and use Black and Scholes model?
Yeah. So first, I'll answer this in two parts. First is the theoretical part. Very theoretically speaking, yes, it's a drawback or a handicap in the model. But let me just rephrase it with a simple example. When you want to see your weight, you get onto a platform scale. When you want to weigh gold, you never use that platform scale. You don't need a gold weighing scale to weigh your weight, right? So the purpose here, what is the purpose here? The purpose here is for estimating a cost which you are going to account. The word estimation itself says that it is not accurate. It cannot be accurate. It can only be reasonably accurate. Now, this by and large addresses the purpose for which it is being used. Now, if you really look at, let's say people who are in option trading, right? What kind of models would they use? Would they just take a simple BSOPM model and work on it? If everybody does that, then there will be very little market, right? So they use much more sophisticated models. In fact, there are ready templates available in the net where BSOPM has been tinkered for even exercise throughout, etc. So there are various options which are available in the world with models which have been developed based on that. But by and large, 99% of the time, this is good enough. Because I will also explain when we go into those 5 or 6 parameters which we need to determine, how we determine and what judgments have to go in there. There are some judgments which are anyway going in there, which takes care of these requirements.
Okay.
So I'll be touching upon that also.
Okay. Sorry
Yeah,
to interrupt.
Yeah.
So I just have a query regarding the risk-free rate of return. In the BSOPM, you said that the risk-free rate of return will be constant during the option's life. But in some of my assignments, I've taken a volatile or a different, risk-free return for every vesting period. I've taken the average for that particular vest. So let's say I have an ESOP that has a 25% in each vesting period. So for each vest, I've taken a different risk-free rate of return. So, and I have used Black-Scholes.
Yeah, no, 1 minute. Let me explain what I'm saying here, and what you're saying is exactly the same. There is no difference.
Okay.
The difference in that model is that, let's say you have 4 vesting. One is 1 year, one is 2 year, one is 3 year, one is 4 year.
Right.
Let's only now look at, see, these are actually 4 different computations. It's not one computation. So let's be very clear about it. Right. So let's look at the 4th year computation which you are doing. In that 4th year computation, you have assumed, let's say, a risk-free rate of 6.5%.
Right, sir.
Right, which is different from what you have used in the other 3 computations. I'm not even getting into it. So this 6.5, the assumption is that from now till the 4th year, it will remain 6.5.
Right.
Which could actually vary in real life. That is what this statement says actually. In real life, even for that 4th year vesting, which you are taking 6.5, it could vary every day, every month, theoretically. So that is not provided for. So that is the only difference. But yes, one of the ways of dealing with that to limit the impact of it is to take different rates for each vesting, which is one of the clear judgments we need to also exercise, which also we will be seeing as we see an example.
But sir, when we take a when we base our calculations based on those assumptions, wherein we take a 3-year or a 4-year treasury bond or whatever the risk-free rate of return. So those why would they change? I mean, they would be on a stable basis. So let's say if my grant date is
No, no, no. No, no. You go to the same source. Probably
Right.
take the report every day or every week. You will find that the rates have changed.
No, but for
Right?
that
For the same
particular-
4-year period, the rates have changed.
But sir, for that particular valuation date, that is fixed, right? When I'm valuing a particular ESOP, my valuation date is fixed.
Yeah. Yes.
So I'm
in
basing
the
yes. So I'm basing my valuations
correct.
based
So
on that valuation date. So for that valuation date
So
and with that,
Pranavji,
yes,
yeah, I understand Pranavji. Let me answer that. Pranavji,
sure.
basically this model, what does it say?
Mhm.
It says one of the assumptions is that it will remain the same what you have assumed on day one
Right, sir.
for that calculation for the throughout the period. But in real life, it is not so. And let's assume you want to consider that factor. This does not provide for it. So
Fine.
that is the crux of it.
Thank you.
In fact, that is one of the assumptions. Yeah.
Kindly, I
Okay,
request
so-
all the participants. Excuse me. Kindly, I request all the participants to take the questions after the present speaker ends, because it interrupts the flow. You might have questions, but you kindly note it down and take it at the last, because we are time pressed.
Yeah, then what I can do is by 9 o'clock, I will finish and then give time for questions. We can take from 9 to 9:15 questions. 9:15, we can take the quiz. That way we can go about. So we will stick to the time. Yeah, so let me carry on. So one of the basic things which is missing in BSOPM is that it does not consider dividends, which is something which may be critical in many cases. So there is also another model called BS Merton option pricing model, where they have made one modification specifically to bring in the factor of dividends also into the computation. So this model is also available readily as a template for use. So that provides for cases where there is a dividend declaration expected during the life of the ESOP. So this model is to that extent better than the standard Black-Scholes option model, because it provides for the dividend declaration in between also. So this is something which can be used. So coming to the brass tacks of this computation, like I said, the mathematics is secondary from the practical application perspective. The crux is the 6 variables which we have to deal with, and how we can determine these and how we can exercise judgment where required. So I'm going to focus on those next in terms of the thing. The first one is the strike price, which is a straight given thing because it's based on the ESOP plan, that the option can be exercised at a exercise price or strike price of 10 rupees, 50 rupees is something which is given as part of the scheme. So that is something which is straight, which can come in. The second one is the time until expiration. Now, this is one of the areas where you need to exercise judgment. So there are few factors which you need to consider. So in fact, one of the things we were talking about is also that the model computes based on an assumption that it is exercised on the exercise date. So the time till expiration is something which is critical for determining. Now, from a practical perspective, what is normally done is you look at the total life of the option, and based on the structure of the option which is being given, make a judgment whether people are likely to exercise it early or wait till the expiration date. For instance, if it is, I'm just juxtaposing two different possibilities. Let's say you are giving a large value options to a senior management where there is a significant growth potential, because they are in senior management at higher levels of earnings already. They may hold on to the exercise shares or hold on and exercise at a time when the prices have significantly grown to get the most benefit out of it. Whereas people who are given, say, 100 options, 200 options at junior employee level, the moment they see some reasonable profitability on that, they may want to exercise and get rid of it, take the money, because for them, its growth is also not going to make a huge difference. At the same time, they are looking to get money in hand. So these are factors which needs to be considered in determining whether people will use the full exercise period or they will exercise early. So this early expiration is early exercise is something which you need to factor in determining, because this will have a significant impact on the ESOP cost which you determine also. So this is something where some amount of judgment and some amount of analysis has to go in to determine what is most reasonable in the given case. Third is the stock price, which, as we discussed, is based on, in the case of listed company, it's simple, it's based on the listed company's share price on the date of the grant. However, in the case of unlisted companies, we need to do a valuation, and like I said, it might have to be done on a conservative basis. So that is the third item. The fourth is the volatility of the stocks. I'll discuss about volatility probably later. I have also, the volatility can be one of the key things which needs, again, judgment. So like time to expiration, volatility is another area where there is a critical thinking which is required. You could look at volatility of your own script if it is listed. You could look at volatility of comparable company scripts if there are comparable companies which are listed. Otherwise, you could take the market volatility and make some adjustments to it if you think that is more appropriate. So these are some of the options by which you can arrive at the volatility. And how to compute volatility? There are models available from the data from the exchange you can take, and you can compute your own volatility where it is not reported in some of the databases. Some of the databases actually report volatility also. The fifth one is dividends. Dividends can be determined again based on what dividend declaration policy the company has, or what has been its past practice, or what is the projections which the company has made. These are bases which can be used. Normally and typically, the dividends make, in Indian context, the dividends make only a small variation in the cost. Unlike volatility and time to expiration, which can have significant sensitivity, normally dividends have a lesser sensitivity to the overall ESOP cost which you determine. So you can look at the sensitivity and then determine whether you need further inputs into it or not. The risk-free interest rate, there are multiple sources from which you can get this data, and ideally you should use the risk-free interest rate for each tranche. Like I think somebody was explaining, you should use it for each tranche depending on the total time for that tranche, so that the risk-free rates vary based on the time period, and we should use the appropriate time periods risk-free rate from the data which is available from, say, FTIL data or things like that. You can use it. So again, just to give the key takeaway, maximum judgment from our end is involved mostly with regard to time from expiration on volatility. These are two areas where there is a significant amount of judgment which may have to be applied. Now, this is just a model which I have shared in my Excel sheet. I've also given the formula for that in the Excel sheet. So the whole mathematics is this, and this is based on the Black-Scholes-Merton pricing model, which includes the dividend. So if you don't want to consider dividend, you can take it as 0 and move forward with this. Now, what is the implication of the various components in the option price? That is the value of the option or the cost of option. Whenever there's a change in underlying price, if it is increasing, then call also increases, whereas in a put it decreases. Generally, we are in a ESOP, we are more interested in the call option. So let's look at that. And whenever the strike price increases, the cost comes down. The time to expiration and volatility is interesting that whenever they increase, both on call and put, you will find that it is increasing because the chances, this is more to do with the possibilities being enhanced. So both cost increases on call as well as on put, the cost increases. Risk-free rate, whenever it increases, the call price increases, and dividend as it increases, the call price decreases. So these are some things which we need to keep in mind to see when we are looking at sensitivity and implications of the computations. So this is one practical example of a case I have taken where stock price, this was a listed company, so the stock price is as at that date as it was required, 93.3, exercise price was 35. Of course, I have changed the numbers and quantities and all that. Date of grant, let's say, was 2005 October, and there was about 1 million options which were being granted, and vesting period over 4 years, staggered vesting, and the exercise period is 10 years from vesting period. So it's a huge, so the last grant will be for 14 years from now. So a huge life which is there. And the vesting was 10% at the end of 1 year, 20 at the second year, 30 at the third year, and 40 at the fourth year. So there is a staggered vesting. Now, whenever there is a staggered vesting, the first requirement is the 4 vesting will have to be done, calculations will have to be done separately. It cannot be done together. So that is the first thing we need to do. It's as though there are 4 grants instead of 1 grant. That's how we should calculate. Some of the parameters might be the same, but other parameters will change. So now this is what was computed. Now the key thing which I wanted to point out here is, like you said, see, the stock price is the same, the exercise price is the same, no problem between the 4 models. Expected life, because the vesting is happening after 1 year, 2 year, 3 year, 4 year, minimum that much time will have to elapse. Here I have presumed that it will be exercised within half a year of the exercise. The rationale was that your stock price is already 93 and the company is doing well. Your exercise price is 35. So already it is in the money for about 60 rupees. Mota. 60 rupees, it's already in the money. And this is being given to a large number of medium, middle level employees. So their intention would be to try and convert it into cash at the earliest. This was the assumption, or this was the rationale which we had taken for this purpose. So, and we had considered only half a year more. By which time,
sir,
can you please park the question for the end?
Okay.
I will take it, Charlie. Right? You can even send a message or chat. I don't know whether questions can be put in here. Otherwise, we can take it at 9 once I finish this, so that we can appropriately take it. Now, at this, the valuations were coming in the region of about 61 to 68 rupees. So I average, let's say 65, 66 rupees was the cost per option which was coming out using this assumption. Now, the key assumption which is differing here is the expected life. And like somebody was pointing out, you can see that the risk-free rate which is assumed for the 4 tranches are different, because the current, at that point of time, what was the current risk-free rate for each of the time period is what is being taken for each of the tranches. So what is applicable for 1.5 years to 4.5 years, that is the risk-free rate which has been taken there. Now, instead of this, if we had gone by the full life, the scheme says 10 years from the vesting. So if I take the full life of 11, 12, 13, and 14 years, and I'm just assuming a risk-free rate of 8, because risk-free rates are much higher at higher this thing. For simplicity's sake, I have just taken the same for all the 4 years. Actually, it could vary there also. What could be the value of option and what could be the implication? Why I wanted to point out this is that this is one of the critical things which we need to consider, because as I said, this whole calculation is being done for accounting, right? So we have to understand the implication of it and then accordingly apply our logic to it. Now, if I take this, it roughly goes up by 25% more than the valuation, or 20%, 25% more than the valuation we had done in the other model. So this becomes a very critical judgment which needs to be taken. So you need to have more analysis, more discussions, and more write-up covering the rationale for why you chose the expected life and what is the expected life you have chosen. Now, this is just an example. Maybe when you evaluate, you might decide, oh, it's neither 1.5 years nor 11 years. It has to be somewhere in the region of 5 to 6 years. So that's something which will vary case to case. But this is an area which needs to be clearly looked at and judgment call will have to be taken. Now, one other model which is there is the binomial option pricing model. There are, of course, let me tell you, there are models available in the internet for computing based on binomial, also ready-made models. But how far it is tested, etc., one needs to be checking. The binomial model is a discrete time model. So it essentially expects that change will happen in every incremental time period of t. Could be days, it could be months, it could be years, whatever it is in the normal course. So on the stock, it is expected that in every time period can only jump in one of the 2 points. So this then is done iteratively over a long period. Now, binomial model without a well-done software solution for multiple number of periods is very, very difficult to execute manually, or even using Excel and all that. It's very difficult to execute. Whereas there are, of course, some models available. Internet provides some models where this can be done using ready-made solutions. However, for smaller things, this can be used. Now, typically how the binomial works is that you start with a stock price yesterday. It can either, like I said, in every time period, it can either only move in 2 stages. So it can go up or go down. And in the second period, it can go up again, or it can go down, or it has gone down and further gone down. So this is how it expands. So when do you use binomial model as against a Black-Scholes model? Now, typically all option calculations, ESOP calculations, Black-Scholes model is good enough. 90% of the cases, Black-Scholes model is good enough. And Black-Scholes model is easy because there is a ready template. You can just put in, you can finish it. It's easier. Whereas calculating using a binomial model requires much more efforts and exercise. So when do you actually use them? When the structure is more complex. In a ESOP, what happens? Within a certain period, you exercise or you don't exercise. That's what is the whole thing, right? There are not too many complications. But let's take a case like you have a optionally convertible scrip. The terms could say that at the end of 1 year, the person who is holding the script could convert it or not. On the end of 2 years, the company may redeem it or not. So like this, there could be multiple complexities which are built into that optionally convertible, say optionally convertible preference share or optionally convertible debenture. Then the complexities are more. You cannot fit it into a Black-Scholes model because the variants are different and increasing. So that is where you need to necessarily look at models like binomial model. So I'm just looking at another area is that where the assumption in the case of Black-Scholes is that the volatility is fixed. Here you are talking about two different possibilities. Like I said, binomial, it can always jump in two ways. Two different possibilities you are thinking of. Possibility one, possibility two can be different, like what we are seeing here. The growth possibilities annually are that it will grow 15% or 5%. So there could be an aggressive growth happening, there could be a slow growth happening. It could be even growth in one case and degrowth in another case, like we saw in the previous example, the price may go up or go down. Then vesting criteria, if the market price at the end of 2 years is over 115, then options will vest, else they expire. So now here the option have become complex. It cannot be just vested on just time elapse alone. It can vest only if market price goes over a certain price. So in a scenario like this, you cannot apply Black-Scholes model. So in complex scenarios like this, we need to use binomial model. So binomial model is, and Black-Scholes is not, a choice of one of the models in every scenario. It is best that we use Black-Scholes model in the normal scenarios, and we reserve binomial model more for specific requirements where there are complex option requirements. So this also I have shared the Excel sheet. So in a binomial tree, what happens? First, you look at the value growth as assumed. Right? Today's price is 100. Stock price at current date 100. So in year one, it can become 105 or it can become 115 because there are two growth possibilities given, assumed. Then when you start with 115 at year one, at year two, it can again grow by another 15% to 132, or 115 can grow to 120. 105 similarly can grow to 120 or it can grow to 110. Now, as per the model which is given, the vesting will happen if the price has crossed 115. So in the first three possibilities, at the year end, it will vest. Year end of 2, it will vest. In the third possibility, it will get cancelled. So the value is 132, 120, 120, and 0. So these are the values which will arise at the end of 2 years. Now, based on that, there is this formula by which you can compute M and B, which are the slopes and the constants for this, and arrive at what is the value today. So value at start for the option comes to 20 rupees, 2052. Now this calculations are there in the Excel sheet. You can go through them over a cup of coffee at leisure later. But this is principally the model which can be done. So you can see the complexities just for 2 years. Now we have to do so much of calculation. Let's suppose it goes into 3 years. Then what happens is 4 becomes 8. It is like the grain, which is, on every chest square kept, and then geometrically increased. So we will, after some time, we will lose this thing. So if we have to do for 10 years and all, we are dead with complexities like this. to do using Excel. So of course, there are some models available, but those models will also be applicable only for specific kinds of complexities in binomial. So that is one of the pitfalls of binomials. That is why Black-Scholes is most useful in the normal course. Only when you have complex instrument, you have to build your own model using binomial. The advantage of binomial is you can build your own model. The disadvantage is it requires a lot of work. So this is the equation calculations for all the cases which I have given as Excel. So I skip some of these because we will be. The third thing which people talk about is the Monte Carlo method in option valuation. In option valuation, why do we use Monte Carlo method and where do we use Monte Carlo method? So first, let's understand the different types of options. European options are payoff computed based on exercise at maturity, which means it can be exercised only on that date. American options can be exercised anytime up to maturity. Now, Asian option is a third thing which is there. Internationally, it is available in some of the other things. The payoff is computed based on average prices of the underlying over a certain period. So, for example, it is neither based on that date or any date in that period, but it is based on an average of, let's say, 30 days, or let's say over a 3 months period. Now, to give you an example, I think some of these gold companies came with investment schemes where they said you put in money, you will get the average price of the next month. At that, you will get gold allotted for that. So things like that. So Asian options, why are they interesting? Asian options are likely to cost less and offers protection from periodic volatility in the market. You know, some spikes on a given date does not affect you because your contract is closing on a particular date. That day spike does not affect you significantly. So those are the benefits of Asian contracts. So by and large, this is not typically required in common ESOP valuations. By and large, okay, this is not required to be used in common ESOP thing. So only when you have such complex requirements, you can then think of Monte Carlo methods, because Monte Carlo methods can do probability for various weightages and calculations. So it involves much more calculations than what is, so the level of complexity for manually preparing it increases from Black-Scholes model to binomial to Monte Carlo. So you also see whether that kind of a complexity is required, then only you use it. Now let me also touch upon the accounting which arises from this. After I finish all this, let's have some interaction on the questions surely. But let me take you through the next two topics also, which deals with what is done with the valuation. Now, in terms of the grant date valuation, the grant date valuation, as I said, is very clearly for accounting. So there are two possible ways of accounting. One is under the IGAP, Indian GAAP, the other is Ind AS. Now, under the IGAP, as of today, two methods are permitted, though they say fair value method is more recommended, but one could use the intrinsic value method. Now, I want to make it simply a understanding for us in a very simple manner, the difference between the two. In the intrinsic value method, you are not separately valuing the option. You only value the share. So you take the fair value of the share and the exercise price of the share without considering the time, etc., etc. So don't go into the option value at all. If there is a difference between them, that is the cost. So, for example, if there is a 1,000 rupee share today and your exercise price, let's say 5 years from now, is going to be 1,000 rupees, the debit to P&L is 0 because exercise price is equaling the share price. Whereas in the fair value method, they say, okay, there is a time, there is a volatility. So there is a value to that option. Compute that value using a Black-Scholes model or some other model. And that is the amount which should be taken to the P&L. So this is the key difference between the two methods in terms of accounting. So Black-Scholes model valuation comes only if somebody is going to do fair value accounting. However, even companies which are using the intrinsic value method is required to give the Black-Scholes valuation or the uh, fair value components as a note in the disclosures. So every company needs to get it valued at the grant date for this purpose, either for directly accounting in the P&L and balance sheet or for giving it as a disclosure. Ind AS permits only the fair value method. Ind AS does not permit intrinsic value method. Now, as per the latest guidance note of the CA Institute, even for IGAP accounting, fair value method is the more prescribed method. Intrinsic value method is only a permitted alternative. So let's look at an example of the grants and how it works on it. Let's say there are 1,000 employees covered by the grant, and number of grants is going to be 200 grants. Vesting period is 3 years. Excess period is 3 years. Then expected life in years is considered here at 5, though the total life is 6. Based on expectation of early exercise, the expected life is considered to be 5. Excess price is 25. Grant share date share price is also 25. Then there is a forfeiture expected of 2%, and estimated fair value option is 10. Let's say when you do this calculation, you are getting an option value of 10. Let's say. Then what happens at the end of each year is there is a change in the sum of the estimate assumptions. The option value of 10 will not be changed, but certain other assumptions like forfeitures, you expected forfeiture when you did the grant at 2% per annum. Now at the end of 1 year, you were expecting it at 2, but the actuals were 3. End of 2 years, you were expecting it to be 4%. And end of 3 years, the actual ended up to be 840 employees. That's it. Because by then you have completed the vesting. So based on this, if you take a calculation of 2 lakh shares as the 200 into 1,000 people, 2 lakh shares as the options granted, what you expect at the beginning to mature is 2 lakhs into 1 minus 0.2 into 1 minus 0.2. So it comes to 188, 238. All this is available in the Excel. Probably we can even take the Excel and see this. Okay, trust you are able to see the Excel sheet where I can take you through the computations also. Of course,
Yes,
the Excel sheet is also shared for your later reviews. Now, if you see this, here basically we are taking the expected options to mature adjusted for the vesting period of 3 years. Right, 3 years is the vesting period. So we have adjusted it for 3 years, right? Basically, it's 200,000 into 1.98, 0.98, 0.98. So that is what is coming here. And the fair value of options at book value, 10 rupees is option price is 10. So the fair value of options for the whole thing is so much. Now, how this is to be accounted is what is given. Accounting of the grant cost will go like this. So at the beginning of the year, you expect 188, 238 to vest. and at 10 rupees. So you take that, multiply it, and then divide it by 3 because you are going to spread it over 3 years, which is the vesting period. So the first year debit to P&L will be 627,460 because you have already accounted nothing on that. When you come to second year, what happens is your expectation has changed now. You are now expecting 4% dropouts for future. So if you adjust for 4%, your expected number of options to mature reduces to 176,947. So the total cost which has to be amortized divided by, right, and spread over the balance period is 1179, of which 627 has already been accounted in the previous year. So the difference you take it to P&L, right? So if this you take for 2 years, not 1 year, 2 years you take based on the revised thing, divided by 3 into 2. And that from that you deduct what you have already accounted. So the balance is 552. If you see, this is reduced primarily because your expectation of number of options which are going to expire has dropped from the previous year. Now, when you come to the third year, actually there are 840 employees only. So 840 into 200 is what you need to give. That's now crystallized. So 840 people, 200 crystallized, right? At 10 rupees. So which is so much, 200 shares each into 10. So this is the total cost, of which you have already accounted 1179. So you account only the balance 5 lakhs now. So this is how the accounting gets done. So you find that first thing is the option valuation is done only once at the time of grant in the normal course, right? It need not be revalued again. It is only the estimation of forfeitures or lapses, which keeps varying, according to which then the calculations and the accounting varies. Right? This is something I want everybody to understand clearly, that we need not do valuation every year if it is a ESOP. We only do estimations and calculations which vary every year. But many a times clients require support on this also, especially when they have multiple ESOP schemes and multiple this thing. They don't have the internal capabilities to do all this. So generally they come to you for this accounting note. So how we differentiate is, one is called as a valuation, the second one is called as a accounting update for every year. So you give them only an accounting advisory as to how to account it. Then let's look at the next step. Now what we have seen is how the cost is booked. 168 is booked as cost. By the time vesting is done in 3 years, 168 is booked as cost. Now let's look at the case that what happens after that. Let's suppose number of employees exercising at the end of 5th year, we say 200 people, right? I think this is the same which is there in the, yeah. So let's say 200 people are exercising by end of the 5th year. Now out of the 200 people, they will have 40,000 options amongst them, 200 per person into 200. So then to that extent, the amount goes into capital and premium, and what amount is received as cash, which is the money collected from them. As per this, 25 rupees into 40,000 shares goes in as cash receipt, and balance gets adjusted to the stock option account. So this is how it gets accounted. And as we saw, out of 840, 600 is exercising in the next year. So same way for 600, it gets accounted. And for 40, they don't exercise at all. It lapses. Now I have assumed here that it is lapsing after the 6th year. However, if somebody resigns and goes and they have not exercised, then some amount of lapsing can be accounted in the earlier years also theoretically, right? So anything which is lapsing after vesting is treated differently. Whereas if you see here, any estimate or any change in lapsing before vesting is adjusted in the cost itself. So by the time we reach here, we have accounted for only 840 employees into 200 into 10 rupees. That's what we have accounted ultimately. Whereas we started with 1000 employees, right? Or rather 1000 into 0.98 into 0.98. So we expected some 941 employees to remain. Whereas we have accounted not for 941 employees, we have accounted only for 840 because these lapses have happened during the vesting period. Now, whatever happens post vesting period is not taken to P&L, right? It cannot be adjusted in P&L. So that what happens is it directly goes from stock option to general reserve. Because this cost is already absorbed into the account, no adjustment is made to P&L, the difference is transferred to general reserve. Now let's go back to the Excel sheet. Sorry, presentation. One second. Okay, so this is what we were looking at. And then I have also given some more examples of what happens when the performance criteria leads to changes. So we saw earlier how number of people vesting varies. Now, if there is a performance criteria based change, how that gets impacted is also something we will see. Now, where number of options vary based on performance criteria. So instead of 200 at the end of 1 year, you expect now only 150 options to go to them because of some performance criteria. Let's say the options were linked to performance of the company, and if the company performs this way, you will get 200, otherwise 150, otherwise 225, like that. So when that varies, when it becomes 150, you recompute based on that. So that calculation is also given here. And similarly, the next thing which can change is the exercise price can change. There also you will find that it has a variation. Now, this I have highlighted in yellow because there is something critical here to look at. When exercise price changes, your option value changes. So please see, everywhere else we have used the same 10 rupees, whereas here it is changing. Now, in a state like this, there is a valuation required again to be performed of the option value. Now, I said normally in an ESOP, you do the option valuation at the time of grant. You don't have to re-perform option valuation every year. I said normally. The exception is, one of the exceptions is this, where the exercise price is going to change, because if the exercise price changes, the option value also changes. So that is something we need to bear in mind. As opposed to this, let's look at how a SAR or a phantom stock works. So what is the difference? In an ESOP, you are given the share. In a stock appreciation right, what we are saying is, boss, I'm not giving shares, etc. But whatever increase in price is there, I will give you that much. So this is the key difference in that. Now, this will involve valuation at every year end. Why? I will explain as we look at it. Let's take the same data, but when you do a valuation, in the first time when you are doing valuation, you have arrived at the fair value of option at 10 rupees. In the second year, when you are doing it, there are changed circumstances, right? Your fair price will be different. I mean, your stock price will be different. your risk-free rate would vary, your volatility could change. So with all that, your fair value at the end of 2 years could be different from what it was at the end of 1 year. So let's assume that these are the fair value or valuations which are done at each year end. So in the case of a SAR, theoretically, if you are going to use a fair value model, you need to do a fair valuation every year end, as opposed to ESOP, which is done only at the time of grant normally. So as this grows, the intrinsic value, which is the stock price minus the what is the exercise price, also varies year to year. Because what is the stock price you have arrived at, what is the exercise price, there is a difference. So that becomes important from year 3, because that is when it vests. Till then it is not vesting. From year 3 it becomes important, that because it gets vested. So when you look at that, so how do you account for it? Is also given in the Excel sheet as a calculation how you go about accounting. So in the initial year, you take 188, which is the number of shares adjusted for 2%. Same set of assumptions as we saw in the ESOP, which is what I have taken here. So for ease of understanding, at 10 rupee value, you compute and take it because it's over 3 years. Now, by the end of next year, the options have changed and now it is at 12 rupees. Why options have changed? Because the expected number of forfeitures have gone up from 2% to 4%. And your fair value at that point of time has also gone up. So you calculate the fair value of that minus what has been already accounted. That is what is taken to P&L. Then year 3, now we know 840 people are there. It is fixed. So the number of options get frozen at 840 into 200. And then of which 400 people have exercised 80,000 shares. So the balance SAR which is going to be there is 88,000 at the end of the year. That 88,000 will be computed at 14 rupees and whatever is exercised will be at 15 rupees. And that's how this computation is coming. 80,000 into 15 is going as exercise cost. So that's gone out. What is the option cost? Then what is the opening provision? Then what should be the closing provision? The difference goes to P&L. For 88,000 shares, which is in my closing stock, at 14 rupee option, what is it that I should have as a closing provision? I keep here. And the balance goes into P&L. Next year, 88,000, again another 60,000 gets exercised. 60,000 into 18 goes into exercise cost. And 28,000 at 18 rupees, which is required to be maintained as a closing provision, gets here. And the differential goes to P&L. Next year, another 140 people exercise. This is assumed as exercise. It could be even lapsed, in which case it will go to this thing, reserve. So this goes to exercise cost and the differential goes to P&L because there is a 4 rupee increase here, 18 to 22. Though we have accounted for it, 840 people into so many shares already, but every year when there is an increasing price, that additional cost will also have to be booked to P&L. So that is what is getting booked here. So the difference, second point of difference between SAR and ESOP is, in the case of ESOP, cost accounting to debit to P&L stops with vesting. In the case of SAR, it can continue till it is exercised because you have promised them whatever is the increase in price, you will give. There is no share for them to sell and take the money. You have said whatever is in the increase in price, you will give, which means then that has to go to P&L. That's why it continues till it is exercised or lapsed. the accounting continues for it. Now, the last topic which we want to touch upon before I take questions and this thing is, we till now saw ESOP from ESOP valuations, R valuation for the purpose of ESOP, etc. That's for the purpose of this thing. Now, many a times we will have another area where we will have a concern, or we will have a requirement to consider appropriately, is when we are doing valuation, let's say for a fundraise or for an IPO, etc. But there is an ESOP which is already promised. How do we factor that into our valuation here? So this is a key this thing. Many PEs have this kind of a scenario where most PE funding, when it comes, there is some ESOP portion which is also there. So how to determine that is something which is again area of interest to know and appropriately consider. Like I said, the principle we should apply always is that the more complex, the more you should spend time on evaluating the depth to which you should go. So one of the things which can be done is always do a sensitivity. Now you find that the sensitivity is very, very small. Let's say whether you consider ESOP or you don't consider ESOP, the share price changes only by 10 paisa. Now you may say, okay, why bother? We will make some simple adjustments and we will make some simple assumptions. Whereas if it has a significant implication, then you would like to look at it much more closely. So one of the things you can always do to sanity check is take all the key parameters and do a sensitivity to find which parameters are giving significant sensitivity to the valuation you are doing, and use those specific items for going into more depth and taking a finer decision on that. So I'm going to now touch upon this. Let's take an example. As of 31st December 2020, company has 1 lakh equity shares issued to its 2 promoters. So only promoters are holding shares, 1 lakh equity shares. They have implemented an ESOP scheme whereunder 10,000 equity shares are earmarked for the scheme. 10,000 equity shares are earmarked for an ESOP. 50 rupees is supposed to be the exercise price. Discount rate considered is say 15%. Of these, 4,500 have been granted. Balance 5,500 are not even granted. And out of the granted, 2,000 have vested, but not exercised. 1,000 have expired, and balance 1,500 are yet to be vested. Right? So this is the broad parameter under which we are going to be looking at as an example. Let's assume for simplicity's sake, the company has no debt or other instruments, and the enterprise value was determined using DCF at 2.5 crores. So now we know the value of the business is 2.5 crores, and it is made up of 1 lakh equity shares and some amount of ESOP. Now, how do we determine the value is the criteria we are going to look at. So let's look at 4 options, right? Let's take one option where we are considering only the issued shares. That is the 1 lakh shares which is issued. Let's look at an option where vested and to be vested is also considered. That is, we saw that 2,000 shares are vested and 1,500 are yet to be vested. So 3,500 shares additionally are considered. Let's look at the third option where vested, to be vested and to be granted are also considered. That is, only the expired are excluded. So 1 lakh plus 10,000 minus 1,000 is 1,09,000. The fourth is the whole ESOP of 10,000 is fully considered, lakh and 10,000. So let's look at all the 4 options. All right. What is the enterprise value? Enterprise value is 2.5 crores. That is given. Now, what is the amount to be collected on ESOP? The amount to be collected on ESOP is 50 rupees exercise price into 10,000 shares, 5 lakhs, right? And discounted at 15%. So the first one is 3,500 shares into 50 rupees discounted at 15%. The second one is 9,000 shares discounted at 15% into 50 rupees. So that is the amount which will be collected. Cash will come into the company of this amount, present value, right? So if you take the adjusted value, it comes to so much. That is this plus the present value of the cash which you will collect on ESOP will come to this. And you get a per share value which is varying from 230 to 250 if you use these different models. Now, when is it appropriate and what is appropriate? This is my generic view. Of course, you need to look at it on a case-to-case basis. In my view, considering only the issued shares is not at all appropriate because there is an ESOP. You have to take cognizance of it, right? Now, when will you take 3,500 only? Let's suppose the transaction which you are considering says that there will be accelerated vesting and cancellation of the scheme. So whatever is there, only will be there, nobody else will get it. If that is the kind of a scheme or that is the kind of a transaction outline, then option 2 is appropriate. Now, when is option 3 appropriate? Where transaction provides for continuation of the scheme, but the scheme does not have a feature of reissue of forfeited shares. So the 1,000 shares which are forfeited, there is no option to reissue, but the existing scheme will continue or will get fully paid for. So in that case, the third option is more appropriate. The fourth is appropriate where it provides for continuance and the scheme also provides for forfeited shares to be or options to be reissued to somebody else. So the ESOP pool remains intact. Now coming to the practical side, most of the cases in the case of PE computations, they go by the fourth. That is, they don't normally upset the ESOP pool. They take the ESOP pool and generally the understanding would be that the ESOP pool will continue. But there could be, different types of transactions based on which the agreement could be that the existing ESOP would be cancelled, etc., and closed at the current point. So those who have vested shares options which are available with them will have an option to now exercise or walk away. So in such cases, you may have to use one of the other models which are described there. So this is a very simplistic method of how you actually give credence to this aspect of ESOPs in your regular valuation. This again, I have included it as a calculation and computation in my Excel sheet. Of course, you can then improvise on it based on the actual scenario. But to get across the principle, I have put a simple example there and given that. Now, with this, as I told you around 9 o'clock, 9 to now, I am ready to now take questions for 10-15 minutes. After the 15 minutes, we will have some quiz questions which will have to be taken. We can go like that. Now I will do one thing. I'll stop screen sharing and then we can go ahead with the discussion.
Sure. So Pranav, this side, again, hi. I have a very basic two questions, sir. The biggest challenge that I face while doing the ESOP valuation is a computation of the volatility, the historical average volatility that needs to be computed. So could you please explain as to how, when I'm doing a ESOP valuation for an unlisted, unquoted investment, unlisted company, so how to go about it and what are the approaches that we can take and what are the indexes that we can follow to compute the volatility?
Yeah. So again, I'm coming to this thing. First and foremost, we have to keep in the back of our mind, 99% of the time you are doing this for accounting, right?
Right.
So you're not doing a hard operation. So this is the first thing we need to understand, right? So if you miss by a whisker, we are not going to be any wrong. All right. So this is something we need to clearly understand, because theoretically there are so many things in volatility that
Yes,
it is impossible to say that this is the volatility.
very true.
Okay, so you have to have decent approach. So first thing is, I will put you to a hierarchy. If you are listed and you have enough depth of market and depth of period of trading, best is to use your own volatility. A. So that is ruled out in many cases. Then we come to B. Do you have comparable companies which are listed, which have depth of market and which have depth of period of trading? If it is there, take their volatility, then take an average of it, etc., etc. So that is the second option. That is ruled out in some of the cases, right? You don't get comparables, or you don't have decent comparables which are of your this thing. You are very small that you are really not comparable to any of them.
Right.
Then 3, you can take some index which is more comparable, and then take that volatility as the indicator volatility. Now, after doing all this, simple thing to run is do a sensitivity. If you find that the sensitivity is too big to your cost of option, right, then you need to see whether you can fine tune it further.
Okay.
Right. For instance, you find that okay, you have used the volatility of VIX straight away. You have not done anything, and the volatility is if you give a sensitivity, the cost is changing only by 5% this way, that way. In accounting, 5% change is not a material thing, so you may even ignore it and take it as that. Whereas if you find it is significantly more, you may want to try and take comparable companies on different parameters and then try and justify it. So this is why I always keep saying that, we can do enough amount of depth of work, but my view, we should do depth of work where it matters. That is where it can have some significant impact to the sensitivity. Yeah.
Right. So one more. Yeah. So the main challenge comes is when we are doing the startups, the ESOPs are issued by the startups. So the comparables are not at all there for startups, because each startup is unique in a certain sort of way. And when we're trying to, calculate the volatility, it becomes very difficult to explain it to the client or the investor per se, when we're discussing the valuation report as to how we are taking these bases. So that's where we come in a fix where how to basically explain. So that's why I asked this question.
So one of the best things which I do is I always especially when we have to get across a convincing this thing, I do a sensitivity and tell them that if you use I have arrived at, let's say, 20%. If you use 15%, if you use 25%, this is how the cost looks. Then they stop the question, because they know that it is not significantly going to kill. So they stop the question there. So best is to address that way.
And so one more thing, in your case study, you've taken volatility of each year in the Black-Scholes model case as a constant. But won't we take the average of vesting and exercise period and the predicted volatility for each vest separately? I mean, shouldn't we do that?
Ideally, like I said, there are umpteen ways of arriving at volatility, and so the point is you have to be consistent. See, as a valuer, 2-3 things very important on a very big picture. Whatever you do for that company, and also across various valuations which you are carrying out, you should be able to show that you are consistent. For instance, if you use, let's say, I'm just deviating, and for an example, you use, let's say, your ERP based on Ashok Damodaran's database, or you compute your own ERP, or you use some other RBSA's publication regularly. These are all different ERPs, and they can be significantly different. Now, you cannot question a valuer why you use this and not that.
Right, sir.
But what is more important is you have to be consistent with what you are using. Now, you can't say, okay, in this client I've used this, in this client I've used something else because it is convenient. Then you are putting yourself into this thing. So today, there is absolutely no one with authority who can say this is the ERP. Same thing
Yeah.
applies for volatility. Same thing. So
Right.
you have to use uh, one, your own consistency, two,
Yeah.
reasonable basis by which you are doing.
So the valuation is an art, sir. I mean, that's what it is.
Absolutely.
So, sir, one more last question.
Basically, sir, I want to ask next question.
Just
Are you
one
done?
last question, then I'll close my queries. Yeah. Just one last question, sir. Can you share any ESOP scheme or any listed companies which uses binomial approach? Because I've not seen it practically. Because every time we do a ESOP valuation, we stick to the Black-Scholes. So, but I would be keen to see it in a practical scenario. Because
Generally, you don't find it because
Yeah.
nobody gives that kind of scheme. See, for example, when you use binomial is when you are saying that my ESOP grant is going to be linked to, let's say, future share price or things like that. That's
Right.
when you need to end up using binomial. Generally, that is not the basis on which they give. Theoretically, that's why I said, 90% of the time, you are happy using Black-Scholes for ESOP. When you use binomial is more when you have OCTs or OCPS, things like that. That is where you will find use of a binomial rather than in an ESOP.
I think, sir, it's more of a convenience also that, binomial, as you discussed in your slides, that it's requires tremendous amount of work and, data that needs to be collated, and accordingly calculations are also much more complex in a binomial model as compared to a Black-Scholes.
Yeah.
So thank
Next,
you so much.
My pleasure. Next.
So basically, sir, just want to understand. In a hypothetical scenario where, say, stock appreciation right has been given to employees, which can only be exercised at the time of IPO, and or probably an exit event, which could be IPO, merger, or anything. Before that exit event, if the employee left, he will not get anything. So how to consider these kind of SARs? Probably how to value these kind of SARs?
So again, this basically you are saying that the vesting itself will happen at a period in future, right? Not a fixed period; it's a variable period. So essentially, you need to apply the same thing. You need to apply a lapsing ratio, which is an assumption at the beginning, and every year you need to update it for the revised assumption on that. In fact, I have given an example there. The same example will be extended. That's all. So every year, based on the new revised thinking of how many people might actually remain and get it, you can keep revising it.
All right. In terms of method, we have to follow. We have to use Black-Scholes, binomial, or Monte Carlo.
Anything, because there you are only arriving at the option cost per share. Let's say the number of options is only a computation outside that.
All right. So basically, we can apply any of the method, right?
Yes, yes.
In the current method, considering there is not much of complexity, we can apply anything, right?
Yes, yes.
Sir, I think thank you. So it's always a pleasure to hear you, sir.
Thank you. Thank you. Next question.
In case of a startup, many of the times, say for example, only promoters are there, and now this is the first time a new investor is coming in. At the time of discussions, they say that we want to reserve certain ESOP pool. So there is no ESOP scheme as of now, no shareholders resolution, nothing. They call it as ESOP pool, and it will be there only because the investor comes in and later I have an ESOP scheme. They may or may not agree. So how do we as a valuer account this ESOP pool? Because the value differs. The price of the share will differ if I consider ESOP pool or if I don't consider the ESOP pool.
See, you use the same method which I explained in the sheet. Only thing is you describe in your report very clearly that this is an ESOP pool which is being discussed with the investor and being agreed upon, subject to all regulatory blah, 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 whatever. So you have described the background to it, and then you are considering it. Many a times, see, though, if you see in my Excel sheet calculation, I have given the money which you will realize from ESOP at the discounted price. Actually, many a times people don't even calculate and take that because it's minuscule. It's not material. Okay, but from a theoretical perspective, you are supposed to take that into cognizance. So I have just shown it there. But frankly, many a times we don't even consider it because it's so small, it doesn't affect except in maybe some paise. So we ignore that, but we surely take the ESOP pool as a quantity because that will have a material impact.
Correct. Thanks.
So just to add to that, I mean, can just my approach. I mean, for ESOP pool, can we show two valuations like without the dilution and with the dilution? I do that when there's an ESOP pool in the company and we are fair valuing the equity shares of that company. So we can show both the
Absolutely.
values in our report, and accordingly the investor or the company can take the decision as to what to be considered, because
Absolutely.
that saves us from any non-disclosure or something. I mean, that's what I do practically.
No, that's a very good approach to show. You can show the stages at which the values, how it is looking, and you
Right.
can give it absolutely not an issue.
Before the next question, I suggest let the poll be launched, and while the people are thinking to answer the poll, the questions can be taken up parallelly.
Poll, I don't see that in my this thing.
Yeah, I'll make you the co-host. 1 minute.
Okay.
Can I ask the host make Mr. Balasubramanian co-host? Chavan, are you there? Okay, I launch the poll.
Yeah.
Yeah, the question can be taken up while people, participants are studying and answering.
Hello? Can I ask a question? Hello?
Yes. While the poll is on.
Yeah.
Yes. So, can you just give me some accounting idea about the scenario where subsidiaries companies employees get the shares of the holding company, ESOP grants of the holding company? I know it's not
Okay, so basically.
Yes, sir.
Yeah, basically there, what happens is the cost is booked in the subsidiary company, depending on the scheme. By and large, it gets debited to the subsidiary company, right? If the cost can be determined like that, and if it is purely based on this thing. So the calculation generally is made at the parent company level because that is where the common working is done. And pro rata, these costs are debited to each of the companies. Typically, the option liability is carried in the parent company's books, and what gets debited to the subsidiary is recovered. This is not considering any FEMA or other implications, but typically this is how it is accounted for.
Okay, thank you.
Yeah. So the first question, we have the poll results. I think you're all able to see it, right? So which pricing model incorporate present value techniques and reflect both the time value and intrinsic value of an option? Black-Scholes-Merton model, binomial model, any of the above, none of the above. And 48% have gone with any of the above. Any of the above is the right answer. Not only Black-Scholes model, but even the binomial model considers the time value and the intrinsic value of an option. If you see the difference basically between binomial and Black-Scholes, it's more on the other assumptions, not on these. These are basic crux of any option value. So it is any of the above. We can go for the next question while, yeah. So the next question on quiz is in valuing SAR, which has a condition that if the share price exceeds rupees 100 by year 2, option can be exercised or else it can be exercised. Which of these models is best suited? Best suited.
as I reiterate, a poll report will be generated and submitted to IBBI. So IBBI will be watching, who is participating, who is not participating. So we request everyone to participate in the poll. CEP credit will be subjected to whoever answers the poll.
I hope it doesn't say answers the question correctly in a lighter way.
Participation.
Yeah, overwhelmingly binomial model. Yeah, like we discussed, the big advantage of binomial model is that it can flex complex structures which cannot be put into in Black-Scholes. Black-Scholes is a simple model comparatively, simple structure which can be addressed by Black-Scholes. So the answer is binomial model. We can have the third question launched, please. The option which is exercised on maturity date is called as yeah, overwhelmingly. I think this has got one of the best scores till now. European option, straight away, yes. The one key difference between Black-Scholes model and Black-Scholes-Merton model, excellent. Everybody is, I think, right on dot here also on dividend payout. Dividend payout is considered in Black-Scholes-Merton model, which is not provided in the standard Black-Scholes model. When there is a graded vesting, what are the parameters which will change in the ESOP valuation for each tranche? Excellent. Both A and C, risk-free rate and time to expiry will vary perfectly on the dot. ESOP cost accounting is permitted to be undertaken under Indian standards applicable to those who are not required to adopt to IND AS. intrinsic value, fair value, both are accepted methods. But I see some people have taken more of intrinsic value. However, actually, both are permitted. In fact, under the new guidance note, fair value of option method is the recommended method, and intrinsic value is only a permitted method. So we are also trying to align with Ind AS as much as possible. So both A and B is the right answer. Expected expiry in pre-vesting period. How is this to be adjusted in the ESOP cost to be accounted? So very interesting. 35% have said considering the number of options expected to be exercised, and another 35% have said that the choice of the entity in either A or B, that is considered as a factor in determining the fair value of options or in the number of options expected to be exercised. Now, as per the guidance note, very clearly this cannot be considered in the determining the fair value of options. The Indian accounting recommendation is that you adjust it in the number of options expected to be exercised. And this is there in both the SEBI guidelines, which have been now no longer valid separately because Ind AS itself has come out with it, and the guidance note of the CA Institute. And that is the examples which I have shown also, that you adjust for this only in the options expected to be exercised. Internationally, both are pursued. People adjust it in the options or in determining the value itself. So both are pursued in global context, but in India, this is the requirement.
So the answer is
adjust it in the quantity.
Option B, right?
Option B, because you need to also revise the estimate every year. The option value which is computed generally is not touched later. So it's not adjusted in that.
This is the last poll question.
To determine the volatility of the shares to be considered for the purpose of ESOP valuation, the data which could be of use is maximum scores on this. In fact, there are few other things also which can be considered in addition to this if available. So I think with that, we have come to the end of poll.
Yes. I request Mr. Ravindra to make announcement as to, few of the participants have asked how to become BVA member. Mr. Ravindra, would you like to share with others how to become member of BVA?
While we wait for Ravi, let me just make a small comment that those of you who got some of the answers wrong, we request you to become members of the BVA so that you can take part in future programs and improve your knowledge levels. And hopefully we'll get it right next time. Ravi, are you on?
No problem.
Oh, yeah, sir.
Yeah.
So I just wanted to invite all the people who have registered for this our program today to become a part of our BVA group. It's easy to become a BVA group. All you have to do is just go into our website bangalorevalues.org, and that will take you to our registrations. There are two types of registrations. One is primary membership, and the other is the associate membership. And all of you, since our register valuers, you can become a member of our register valuers primary member group. And the fees is 3,000 rupees. And there is a discount which is going on. 5% discount is there till 31st of March. So I request you to avail that and become members. That's it from me. So back to you.
Now I request Mr. Gnanaprasad to formally convey a vote of thanks to the speaker.
Thanks, everyone. Thanks, BVA at the outset for arranging such a superb speaker. BVA has been consistently welcoming speakers at great higher level. Their knowledge is great and experience is also so. I personally now thank Mr. Balasubramanian for giving such enriching knowledge in the ESOP, because ESOP valuation is one which is very complex, and every time we visit that, different interpretations come. Like we read Bhagavad Gita, different interpretations based on our experience come, like that it is there. But that clarity with which you gave, it is dot on, and that is also reflected in the poll questions. Everybody has got it right. And you took what is the share valuation, what is options valuation, what is the methods of options valuation, or why we use Black-Scholes model, when we use binomial model, when we use Monte Carlo model, and also valuation of share and everything. Entire ESOP, you have covered it very well, and the articulation, I will thank you, sir. You are very dot on it, and it was like seeing a thriller movie. The entire thing was you are gripping the audience to very much. As they say, noble thoughts come from various people, and we have to accept it. Ano badraha kritavo yantu vishwataha. Like that, these noble things we assimilate, we will try to do it. We will revisit your presentation and other things, and when we have any doubt, we will approach you, sir. Thanks for your presentation. Really wonderful presentation, sir. Thank you.
Thank you all. Thank you.
Okay, all, have a happy weekend. Let's meet in the new financial year.
Happy year and also, madam. Thank you.